Hello and welcome. You're joining us live on the Investor Lab, the home for passionate property investors and people seeking a life of freedom, choice, and abundance. Gabby, how are you? You looked at me funny then.
What is your name? Who are you?
Who am I? We've been together for 7 years, and you're like, hi,
nice to meet you.
Nice to meet you.
Good
My
day,
name's
good
Goose.
morning.
My name's Goose.
My name's Gabby.
Great, nice to meet you
nice
too.
Nice to meet you.
JCP in the chat, hello and welcome. Good to see you there. Very excited to be back.
Welcome.
So we've got a couple of people joining us live today, which is awesome. Personally, I'm enjoying doing the live format. How are you feeling about the live format?
You know what? I'm actually really looking forward to these on Fridays.
Yeah.
Yeah, I'm coming in. I just think it's fun to connect with the community, have more interactions, get more you get FaceTime with us. We'll figure out a way in future that we can get FaceTime with you through this as well. But it's
That'd be cool.
It would be cool.
Yeah.
I fantasize about it. Anyway. Let's not pull on that thread. I really enjoy these episodes. I think we get a lot out of the obviously back and forth with each other is fun and the bane of my existence, but also the back and forth with the chat. We just really thrive on supporting and guiding and answering questions. So as we're coming into this episode, if you are joining us in the chat, say hello, say good day. As soon as you have any questions, just send them through. Obviously today, we are talking about investing strategies for 2025. Now, if you're coming to us, if you're joining us from our email list, it's probably coming about from the perspective of thinking about property investment. Obviously, we are going to touch on that, but this is more kind of holistic investing and how to think about investing in 2025. Property is a piece of that, but also just how to think about the different types of assets and the different things that you could invest in, because I really wanted to come to the table with this concept because I think a lot of people might get fixated on a particular asset type and not think about why they've chosen that particular one or why that might make sense for this point in time, this point in the cycle, this point of the cycle of that asset type, all of these different variations, and then layering that with your situation and what you need and your goals. So we wanted to kind of start this by bringing together all the different asset types, kind of give you a 101 on the different characteristics of them and comparing them. And then we're actually going to dive into what Goose would do in 2025, factoring in the different asset types. So
Yes, we are. So by the way, if you're here and you're joining us live and you're in the chat, I would love to know, what do you think is the best investment opportunity in 2025.
Nice, yeah.
So if you're in the chat, let us know what you think the best investment opportunity is in 2025. Peter Boone, nice to see you.
Peter Boone.
Great to see you. Let us know what you think the best investment opportunity in 2025 is, and we're going to get stuck into it because it's very interesting, right? And I think about this a lot, and I think I think about this kind of stuff more than you do, and so I'd be interested to kind of get some reflection from yourself as well, particularly because in 2025 there's more and more. Nice one, Matthew Pitt. There's more and more noise in 2025. I think that we've gone through a period. Like if you go back over the last few years, we had COVID and we had that kind of V-shaped recovery, and then we had a ton of stimulus. Then we had this big everything boom, and then we had everything tightening. We had interest rates rising around the world. We had, all of this kind of stuff going on, and so we've gone through these kind of waves of emotions, waves of liquidity, waves of opportunity. If you looked at the NASDAQ, for example, from 2022 to, I don't have the numbers in front of me, but for in 2022 to 2023, mid 2023 or something, it was down 20% or something. So we've had a lot of volatility over the last couple of years. Volatility to the upside, volatility to the downside. We've seen different property markets in Australia go in different, move in different ways. And so I think in 2025, it's really shaping up to be a very interesting year. Interesting for a number of reasons. Interesting because we are seeing a lot of political change. There's going to be an election in Australia this year. Yeah. Obviously, the US election recently, and that affects global geopolitics, global liquidity, all of that kind of stuff. We've also had globally, interest rates going down, and we've had liquidity increasing. In fact, the PBOC yesterday printed nearly $1 trillion yuan, which is about $180 billion US dollars. That was yesterday that they printed that, and they are getting the Chinese economy is in trouble, and they are desperate to print. The only reason they're not printing is because the US dollar is too strong, and we sort of touched on that a little bit in last episode. But there's a lot. The point is, there's a lot happening here in 2025. There's also way more opportunities. Everyone's like, oh, Bitcoin's hit $100,000. Should we go and invest in Bitcoin? And oh my God, but I heard about this this other thing, or Dogecoin or something like that. Or should I just stick to property? Or should I invest in capital cities? Or should I invest in regional? Or should I invest in something else? Right? Should I start my own business? There's so many opportunities available to us in 2025, and I think more than ever, you really need to be thinking critically about where you are in the cycle, what opportunities that presents, and why you would make those decisions. So I think today it'd be good to go through some of those options and start to go, okay, like, how might you think about investing in 2025? Because 2025 is different from 2024. 2024 is different from 2023. It's going to be different from 2026 as well. And so thinking about how to make appropriate decisions at appropriate times is really, really, I think, fundamental to this conversation.
Yeah, awesome. I think as well, you have a concept that you mention a lot, which is capital allocation.
Yeah.
And really, as an investor, I think a lot of Australians like to think about property, right? We've got this obsession with property investment and just owning property, and that becoming an easy step to build your wealth.
Yeah.
But really thinking through beyond property and thinking as an investor and developing this skill set and this mindset of, okay, property is an asset class. There are all of these other asset classes. And as you mentioned, business is an asset class in itself.
Yeah.
And thinking through, I, as an investor, have this amount of capital that I can allocate. How do I approach doing that and being much more strategic and kind of stepping above the individual asset? Because if anyone is in any property groups or property forums or things, you can get very deep into technical property research. Yeah. There's so much to it about trying to pick the right location and the right strategy. And there's a variety of strategies just within property investment in itself. But trying to zoom out of that and thinking about the asset class in itself as, is this where I want to put my capital in the current market, in the current stage that we are at in the world, in the global economy, local economy, everything considered? Is this where I want to put my capital?
Yes, I agree. Yes. And there's also a strategy piece in there as well. And I'm actually just, I've just seen, I think it's Braden has...
Hey, Braden.
Hey, Braden. He's put a comment in there, which has prompted me to look up something. So it's also important to think about strategy. Yep. It's also important to think about strategies. Apologies that I can't type and talk very well, and this is live, and I am trying to do something meaningful.
I would try and pick it up, but I don't know what you were about to say.
No, well, I'm just trying to set up something. So, so there's a comment here as well that I can't tell you what's good, but I can tell you I want to try and generate meaningful cash flow. Now, capital allocation is not just about trying to pick the right assets at the right time. That's. If we just think about it like that, it's like, all right, so in property, how do I find the latest hotspot? Mm-hmm. Now, just finding the latest hotspot actually isn't necessarily the answer. It's like, what's the strategy? So finding the right opportunity that is aligned with your strategy and aligned with your goals is actually really the key. Now, there's a really interesting thing. There's a really interesting thing around cash flow that I think is really worth talking about. And I actually mentioned to you last week, I want to do a whole episode just on this. I think a lot of people need to reframe how they think about cash flow. Now, it depends on where you are in your portfolio. If you're still in the sort of prime earning years of your life, generating cash flow from your property portfolio or from your portfolio generally might not actually be necessarily the best way to do it. Because if you think about it like this, the marginal tax rate on, let's say you want to have $150,000 in cash flow, let's just say, in 1 year, right? The marginal tax rate on that would be 37%. If all you did was get that $150,000 in cash flow from your portfolio, whether that's from dividends and stocks or whether that's from your property portfolio or whatever it is, you'd pay 37% tax on that. Now, if you were also working and also earned $150,000 a year, then you would have $300,000 of income, so you pay 45% tax on that income. Whereas if you, for example, had a property and it went up by $150,000, let's just say you netted $150,000 after all of the selling costs and all of that kind of stuff, and let's say you'd held it for more than 12 months, you would only, in practice, pay 25% tax on that. So if you netted that back in 1 year, you would actually be better off than getting that in income. Now, I say that it really depends on where you're at, what stage of your portfolio you're at. Because if you're 60, right, or you're looking to not have any other source of income, then you need to be really mindful of where that capital is and whether it's liquid or illiquid. Because, I would strongly argue that if it's in property, we've said tons of times before, you can't spend your equity. But if it's in a more liquid asset, then you actually can, right? You could invest in something that's more liquid, whether that be, say, Bitcoin, or whether that be some other asset like equities or something like that. And if it goes up by, let's say, 100%, you can spend some of that and you're spending the profits, right? You can take that out, you can use it like capital and keep your original capital. So I think, and thinking about how capital gains tax versus income tax works is a really interesting conversation to have. Now, we don't want to spiral out of control and go in a completely other direction, but I think it's really interesting to consider that, because ultimately what people want enough surplus capital to be able to go and live the life they want on their terms. How that gets to you is also just as important as anything else, because personally, I'd rather pay 25% capital gains tax than pay 45% income tax.
Yeah, which is, I think, again, it might be a mindset shift for as you're developing as an investor, because I know a lot of people, particularly, let's just say it's someone that owns their home. Now, home's a bit different because CGT applies differently there, but it is a big kind of fear that we have. I think we're all drilled into fear tax and we want to pay as little tax as possible. And so this idea of CGT, yes.
I hate tax.
I also want to pay as little tax as possible. You know what I mean? Like, a lot of people have this, I need to avoid CGT at all costs, rather than thinking about it as a tool in the whole journey. Similar to like, people want to avoid paying LMI when they buy a property as well. In certain situations, it may actually be a helpful tool for you to be able to get into an
Most
asset.
Most of the time, it's better off paying LMI than not, right? So,
sure, But I just say, like, it's a mindset thing that I think people
100%.
need to. It starts with acknowledging it. It starts with realizing that that it's something that you believe, and it's something that it's not necessarily factual. So it's just noticing that.
Yeah, totally. Shampoo time. Love that name, by the way. Great question. No, we're going to come back to the question later. We need to keep going. We actually need to get into the meat and bones.
Okay.
Yeah. So shampoo time. We're going to come back to that later. So
meat and bones.
I have no idea what you just said about meat and bones.
I heard you say we're going to get into the meat and bones.
Maybe that's what I did say. I'm not sure. I'm not sure. We'll have to watch it back.
That works.
Yeah, into the meat and
bones.
Potatoes, maybe.
There we go.
We need to get into it. We need to get into the bones of it, into the meat and the bones of what we're talking about today. Otherwise, we'll never get there. But please do drop your questions in the comment section or in the chat there. We will answer them. Definitely,
Great.
We'll come back to that. But I want to make sure that we don't get too off track. So,
yes, good, great.
So we've actually there's been a bit of an evolution, guys. We've really stepped up our game. We're actually learning now how to share things on the screen.
Do we own a tech company or what?
So we're going to share some stuff on the screen. But let's keep rolling, because we want to talk about just a handful of kind of like the most common asset types that you can think about.
Yep.
How you might think about them and how make some decisions around it. And then we're going to walk through 6 different scenarios around how I would personally allocate capital in 2025. And again, none of this is financial advice. All of this is designed to be just whatever education and information purposes. And even when we go through what would I do with different sets of money, that's going to be based on how I think about it. So you and your personal situation is going to be very, very, very different. So just bear that in mind, that none of this is financial advice. It's just here to help you think and navigate through the market effectively.
On that as well, I will actually, we do need to emphasize this, because I think a lot of people in this space don't really want to talk about different asset types because of this need to disclaim information, because we are not advising you. Like, I don't know your personal situation. I can't tell you go and invest in this. We're going to talk about capital allocation scenarios a little later, but that is for us personally, how we would approach it if we had different capital positions for this year. This really is because we want to help educate you, and we want to help give you a baseline understanding of the different asset types. Again, like I was saying, because if you're coming into this, you might just think about property, and we want to think about how property fits within the scheme of investing. Because I think as well, if you follow other people online, you will tend to get one asset class kind of talked about. And then that's when it feels kind of weird because people just kind of like push, you have to get in now, you have to do this. We are not going to do that unless it is like genuine because we can see things. We do a lot of research. We have a whole data science team. Like there's a lot happening that we can actually put our word behind and say, this is where we think things are going to go, but we're not going to push things onto you. And it's about being able to understand, okay, this person is saying this thing, this other person is saying this other thing, this person says shares, this person says crypto, this person says property, being able to develop that skill to discern that for yourself and apply that to your own strategy. So
I consume about 40 hours a week of information around investing and macroeconomics and all of that kind of stuff. And one thing
we don't talk much.
No, I listen to everything on double speed, but you know, there's like, I listen to a lot of the same people, but the thing is they all say different things and that's good. That's good for me because what I do is I listen to all of their perspectives and then I try and work out where are the commonalities and how do I form my own individual, my own individual opinion on that. And I think that's a very important thing to do. You don't ever want to just take somebody sort of shouting from the rooftops, you must do X. You have to take the time to try and understand it. So let's get into it. Let's go through some of these. I'm
going to try and share the screen
because I'm very interested in trying to get some dialogue around some of the capital allocation stuff that we're talking about as well. So
great. Ta-da!
Okay. Ta-da!
Sharing screen.
We shared the screen.
Wow.
Woo. All right. So do you want to go through this or want me to go through this?
We can do it together, but we can see like the different asset types, asset classes across the top. Again, this is a selection. There are obviously other things that you can invest in the world. And then we've also pulled out, I think it's six key categories to kind of compare different characteristics between the asset classes. Because again, I'm thinking through people that have some background with real estate. Maybe you own a property already. Maybe you've invested in real estate, or maybe you have no idea. Maybe you're coming into this and you're like, okay, 2025 is my year. I hear you guys. I understand that I need to get my shit together this year. Property seems like a good thing, but then like we've been saying, all of these different people are telling me all these different options. I really don't know what is best for me. So we're trying to break this down in this table.
I'll also point out that this table is subjective. This is based on our opinion.
Yes. And
So
we have debated this table.
Yeah, we sat there last night. We debated this table a bit, and we actually have differing opinions about some of these things as well. So this is designed to again kind of prompt thinking, as opposed to be some sort of gospel of like this is the risk profile of it. It's like this is our opinion.
Yeah.
This is how we think about it.
Perfect.
So do we want to go through it by asset class or do we want to go through it by category?
I would say by category because I want people to try and think about it as. So like the first category we have here is risk, right?
Yeah. We're going to be mindful that we don't take 2 hours to get through this as well. So we want to...
Yes.
Right,
we're already 20 minutes in.
So we want to move through. We want to move through it quickly enough. We're going to link this in the show note, in the description as well, so you can get to it as well.
Yep.
So actually, can we go through it actually by asset class? I think it might actually be useful.
Okay, cool.
To do it that way.
Yep.
We'll end up comparing everything anyway.
Yeah, for sure.
So as most of you know, we run a real estate investment company called Dashdot. We're very proud of that. We get the best returns. We get the best results. I'm very happy with that. So I can say that very confidently, and that's not grandstanding. That's just facts. Now, the reason that we started the company in real estate is because we felt like we could help our clients get the best possible returns in real estate, and we said for a very long time. If we don't care about real estate, but we think it's the best way to help people to build wealth, and if that ever changed, then we'd communicate that clearly with people. This is in effect part of that discussion here, because actually we're saying, you know what, there actually might be some other ways that people should consider. That being said, despite all of the hype and hyperbole that you might hear around different opportunities, in my opinion, real estate still represents the best risk-adjusted return basis. The risk profile is, in my opinion, very low. Right? When you think about risk, so volatility is not risk. Volatility is just volatility. That's all it is. It's just how much a price might move. It actually doesn't necessarily impute risk specifically, unless you sell at the right time, unless you're forced to sell. But that risk exists everywhere. But the reason that you're able to get good leverage on it and all of that kind of stuff is because it is low volatility. It tends to not have big swings. You know, if you look at the biggest like property market dips, we're talking like 10, 11% in many cases. There are cases where there's been more, but generally speaking, as an asset class, it's very low volatility, very stable, and you don't have to put you can put 10 to 20% of the capital in there with leverage, right? So it's a pretty low risk proposition, I think. I'm going to keep hooning through this, and then you can kind of pull me up on anything you want to get into.
Yeah, just on that with the risk. I know we're on square one, but the concept. I think people fear a lot getting into property, thinking about because markets do, like there are downturns and there are fluctuations within markets, but I think we're talking about longer term than I think a lot of people are.
Yeah.
We like to invest, generally speaking, into like buy and hold long-term, thinking through wealth growth rather than...
It's not get rich quick.
No, and it's not like, hey, put this amount into property and then in 6 months take it out again. It's not that's not what we're talking about here.
And by the way, so it's going to be really good because you and I are going to have different opinions on some of this stuff, and it's really important. I think that it's important to have different investing time horizons for different asset classes based on different reasons.
Yep.
So I'm quite happy to walk through that because... So, I mostly kind of manage our investments and think about that kind of stuff. And that's exactly how I think about it. We have some stuff that I've invested in and I'm like, I don't care what happens for the next 5 years because it's like, we ain't touching it for 5 years, right?
Yep.
And there's some stuff where I'm like, I'm very interested in what's happening in 2025 because I expect to sell it before the end of the year.
Yeah.
Right. And so having different time horizons is really, really important. So why don't we hoon through some of this stuff? Let's hoon.
Let's go.
So real estate is quite low risk, right? On a even if you make a mistake, if you just wait a long enough period of time, assuming you haven't bought a shack in Upper Conductor West or something, then you are probably going to be fine. So generally speaking, it's a very safe asset class. The returns can actually be very, very, very high. Now, a lot of people think about real estate and they think about, it gets like a 8% return a year. That's what we worked at 8.25% since 1965, I think it is, on average in Australia. It gets about an 8% return a year. We've talked about the monetary debasement rate of being like 10%. It's slow. It doesn't do much. It's like, top line, right? But if you add leverage to it, then you can get really, really significant returns. In fact, I did an example, and we don't have to share this on the screen, but if you bought a $600,000 property, and if it grew by roughly these figures are not going to be exact, but if it grew roughly by 8.4% a year on average for 10 years, and if you had an 88% LVR loan, and I'm throwing around a few numbers there, but basically a 10% deposit with LMI plus costs, okay? So the total cash into the deal would be circa 140, 150.
Is this the Apex report?
It is the Apex report, but it's probably going to be too complex to share. The point that I want to make, though, is over a 10-year period, using quite conservative averaged numbers, calculated maintenance costs and stuff, you could get a return on invested capital of about 400% over 10 years, which works out to be a compound annual growth rate of about 17.5% roughly, which is quite good. So if you think about the monetary debasement rate of roughly 10% a year in Australia, you're beating the debasement rate, you're getting ahead, you're doing great, right? So the other side of the coin to that is that our clients have consistently, probably not the right word, it's very common for our clients to see triple-digit return on invested capitals in a year, 2 years, 3 years, right? So when you think about returns, like where else are you going to get those returns? You look at the S&P, you look at the S&P 500 as a kind of a good proxy. The average return on the S&P 500, let me just quickly get those numbers up, over the last 10 years is 11.23%, right? So if you use that, a lot of people think about the risk-free rate of return. If anyone's ever heard that term, usually that's pitched against like a 10-year government treasury, right? And they go, okay, well, the risk-free rate is whatever the rate for a 10-year government treasury is, right? It's typically a US treasury, but you could use the Australian treasury as well. That's kind of evolved now, and it's kind of like the benchmark, the performance benchmark is the S&P 500. Can you beat that? So the S&P 500 has grown by about 11.23% now over the last 10 years. That's roughly the monetary debasement rate over the last 10 years. So pretty much the S&P keeps up with monetary debasement. So, really what you want to think about is, can you beat that? And if you look at property, use some pretty conservative estimates, looks like you're going to beat that by a pretty long way. That stacks up very well over any kind of medium-term time horizon. Now, real estate is not something that you should get into and out of quickly. It's got a very high barrier to entry that actually makes it very difficult.
Yeah.
Yeah. So it actually makes it very, very difficult because, once upon a time, you used to be able to, like when we very first started, it was like, hey, 50K, you can get into a property. Now it's 70 to 100 or more to get into a property.
Yeah. I just, that's kind of why I thought to put this table together. It's all well and good for us to talk about property and talk about get in, but we are also in the middle of a housing crisis where affordability is getting worse because of multiple reasons that we've already discussed in previous episodes. But we are shouting about you need to invest, you need to get in, you need to make your money work for you because it is going to basically waste away over the next however long, 10 years.
Yeah.
And so if you are not able to afford a property right now, or you have more money than you can afford to buy more than one property.
Yeah.
And so you want to think about what else can I do? I've got this leftover cash. I've been able to buy one, but I have this leftover cash. It's not enough to buy another. What else can I do? So
we'll get to the capital allocation stuff a little bit later, right? So because that's really important how to think about that.
Yep.
Because really the goal is how do you beat the monetary debasement rate? Then how do you beat a risk premium on top of that?
Yep.
Okay, because in order for you to accrete more value, you have to take more risk, right? And that's and so it's not just about can you beat it; it's about can you beat it on a risk-adjusted basis. So you have to beat the monetary debasement rate by a certain amount, and you also have to be able to do it on a post-tax basis. So as Josh put in there, he said he was pretty shocked when he learned that the S&P basically keeps up with debasement. It basically does keep up with debasement, except then when you pay capital gains tax on it, you end up negative, right? So you basically can't get ahead when you invest in the S&P 500. So anyway, real estate's got a very high barrier to entry. That makes it difficult. But one of the benefits, very high leverage, that amplifies your returns. And that also allows you to benefit from debasement because you're spending, if you've got a 30-year mortgage, you're basically you're basically shorting the dollar. You're saying, okay, yeah, I'll pay you in whatever the hell you've done to the money in 30 years time. You know what I mean? You're pushing it out and saying you're gonna corrode the money. Yeah. Sure, let me pay you in your broken money later on. Thanks. Give me the money today, and I'll pay you back when as you keep breaking the money. I'll pay you back in that worthless junk later on. So it's awesome. Like it's a way to kind of use the system against itself.
Which would be interesting to dig into, not now, but comparing it with the concept of the interest rate on mortgages, because a lot of people don't like the concept of I'm going to buy this value property today, but over the lifetime of my loan, I'm going to pay much more than what my loan says based on compounding interest. And it's comparing that with, yes, but your cash is... Yeah,
if you've got a 7% interest rate on your mortgage and a 10% debasement rate of the currency... There's an arbitrage there,
quick
right?
Math. Yeah.
Yeah. So, and it was quite funny because when CPI, which is a horseshit metric anyway, when CPI went above the mortgage rates for a little period of time there, it was everyone's like, oh my god, it's like free money, because the inflation rate was greater than the interest rate, but in fact the monetary inflation rate is greater than the interest rate anyway. So like taking out debt is just like getting free money. It's now you got to do that carefully. You got to be sensible about it. I don't want that to seem like an irresponsible statement. But it's like it's ridiculous, right? Anyway. The best way to think about it is you're shorting the currency, but you want to make sure you're doing something that's not too volatile. And if you look at this chart, real estate is the only one that we've marked green. It's the only one. It's the only thing that I'm like, load me up, give me the debt. But I wouldn't do it on anything else, really.
Yeah.
So now, one of the problems with real estate, very low liquidity. This is actually one of the things that actually creates the stability. So the more liquidity, the higher the volatility. So the more liquidity, the higher the volatility, right? Is as a general rule, which is why Bitcoin is more volatile because it trades 24/7. It's more volatile than stocks, which only trade 7.5 hours a day. Like, I don't know, I can't remember how many, like 200 days of the year or something like that, right? And you'll note here, if you just, we'll get to it in a minute, we'll come back to it later, but some cryptos and altcoins, you would think they trade 24/7 too, sure, but some of them have low liquidity or low float, right? And that actually can actually be bad, right? You can end up in a situation where you can't sell things.
Yeah. So you'd think through as a general rule of thumb, like the negative of having it not be very liquid, real estate not being very liquid, means that it has an upside, being that it's not very volatile.
Correct.
So it's like you're trading that off.
Yeah. Which also means that you can leverage it, which also means that you can amplify your returns.
Yeah. Yep.
Right. And so a lot of people look at these things like you could very easily argue that they are negatives, but those negatives become the positives. Those negatives are the strengths. Like the fact that real estate is slow moving, the fact that it is not very liquid, the fact that it is not very volatile, all of these things can seem way less exciting or cool compared to, like, I don't know, Bitcoin, but they are actually the strengths. And it is in those strengths that you can get the same kinds of returns that you can get with other things, right? So you can get in real estate, you can get the same or better returns than you can get in Bitcoin, which is a crazy statement to make because people are like, oh my God, that doesn't make any sense. So the average compound annual growth rate of Bitcoin is about 60%, 50%, 60, it depends on when you measure it, but like we'll call it 50 to 60% compound annual growth rate. So it's like, can you get, and assuming you don't use leverage on Bitcoin, can you get a better return than that in real estate? Well, yeah, you can. So the average return on invested capital in the first 12 months for our clients is 67%. That doesn't mean they get that every year. But here's the thing about real estate. Because it is low risk, it is highly stable, it is high barrier to entry, it is not very liquid, right? Because of all of those characteristics, you can comfortably grow your capital in real estate, refinance that equity out, move it, buy another property. You can take out your original capital and then just play with the tables money, right? You can have a portfolio where it has an infinite return because you've taken out all of your original capital and you're running the portfolio just on the capital that's created from the portfolio. Or you can amplify it. I mean, we 15x'd our money in 5 years in real estate, which is great. And that's not because we did anything crazy. We just bought some houses and forgot about them for a while, right? So you can do it intelligently with real estate, and you're not going to get those kind of returns in other places because of the ability to leverage that and to be able to create, in effect, an infinite money glitch. Now, there's a limit to it, and that limit is going to be constrained by your income. And I think Braden just said there that personally the income that he was talking about would be geared at being able to purchase more property, 100%, right? So if you want to expand your ability in real estate, you need to consider income as part of the equation. You need to consider yield as part of the equation. You need to consider the cash flow component of your portfolio as part of the equation in order to be able to continue to expand how big you can play that game. But that's not where the real gains are going to be coming from. The real gains are going to be coming from growth. So have we covered real estate?
I think so. I mean, I would love to get questions, but we are hooning through.
We've got so much to cover.
Okay, let's move on.
But we can keep asking questions. If you've got questions or comments, drop them because we are looking at them and we will cover them off. And Peter, I will come back to your question around, there was a really great question in there. What would about the best asset class to invest in 2025 for the next 5 years to grow your capital as fast as possible and no impact on your cash flow? Peter, I'm going to cover that actually in the capital allocation section. So stick around for that because I think about that a lot. I think about different time horizons. So we'll cover that. All right.
Sweet.
Let's keep moving. So business is an option. A lot of people think, you know what, I'm going to start a business. Here's a hot take. Business is more accessible than ever. It's easier than ever to start a business, but that actually is a bad thing. That actually increases the risk because once upon a time, the barrier to entry was harder. It was harder to get started. Less people did it. Entrepreneurship wasn't as cool. Now, every Tom, Dick, and Harry can do it. There's all kinds of technologies and tools to make things easier, more accessible, which actually means that there's more opportunity for it. Kind of saturates the market a lot easier, which actually increases the risk and decreases your ability to create capital. Not only that, it's technology is increasing at a much faster rate, which creates another existential risk. But I would actually say that because the barrier to entry to get into business has gone down, that actually increases the risk, which is very interesting because the hardness of something actually decreases the risk. So if you think about like the hardness of Bitcoin, the reason Bitcoin is, in my opinion, low risk, and we had a really good debate about this last night, is Bitcoin high risk or low risk? I think Bitcoin is extremely low risk. And part of the reason it's low, not the main reason, but like part of the reason is that it's very hard. You can't inflate it, all that kind of stuff. So the less hard something is, which includes how hard is it to get into business, is it easy or hard, right? Yeah. The less hard something is, inherently, the more risky it gets. So I think it's an interesting thing to consider.
I think with that as well, obviously we're not at Bitcoin yet, but my argument about the risk profile is again coming back to the volatility aspect, because I think so many people, you have a much longer time horizon. I can't remember the phrase of it's time preference.
Yeah. High time preference and low time preference.
Yeah. And so if you have, I can't remember which phrase is which, but you see things on a longer time horizon, right?
Yeah. So someone with a high time preference is highly focused on their well-being in the present and immediate future. Low time preference
the short term
has got a longer time horizon.
Yeah. So you have a low time preference.
Yeah.
And I think as you mature as an investor and start to think about this, again, zooming out a little more, you develop that and you think more long term. Whereas I think a lot of people, particularly just the current economy, and thinking through how do I, not necessarily how do I get rich quick, but because people don't want to admit that that's what they're thinking, but if we could maximize my returns in the shortest amount of time, why wouldn't I want to do that?
Yeah.
And so my hesitation when we talk about is Bitcoin low risk or high risk is I just get concerned about people jumping in that and not being aware and comfortable with the volatility that is likely to come in the short term.
Yeah.
Like we believe long term in the trajectory of the asset, but the risk comes with understanding that this volatility is going to come and being comfortable with that. That's if people are comfortable with that, then it is low risk, in our opinion.
Yeah. So, and I also think that this comes into cycles and understanding where we are. So that's why 2025 is different from 2024, right? So we were actually talking about this yesterday, and somebody that we know has $50,000, and they were like, "Oh my gosh, should I just go and buy Bitcoin right now?" Now, I have a very strong opinion on Bitcoin, and we'll come to that in a second. We should move quickly through this because I think we'll get into. I think we'll get into more interesting and robust discussions, right?
Yeah.
So, now. My opinion on that, even though my opinion, I'm happy to go on record and say I think Bitcoin will be worth $1 million in 2030. That's my base case. I have a bunch of reasons why I've developed the thesis that I believe that to be true. That's my belief. I think it's going to $1 million by 2030. Cool. You don't have to agree with me. That's cool. That's my opinion only. So on that basis, it's like, should you just yeet all your capital into it right now? Well, maybe not. If you're asking me in 2023 or 2022, I would have been like, yes, take all of your money and chuck it in there. Because if you've only got 50 grand, now we're getting into the capital allocation conversation, which we'll come to later, right? But in 2025, do I think that's still the smart move? And I think you should be a little bit more careful, cautious. And I'll explain why when we get to the capital allocation piece.
Cool.
So anyway, let's just quickly whip through business. So business, it's very high risk.
Yep.
There's a high risk of failure. And the returns can be mixed. A lot of people don't make that much money in business. Most businesses are very small businesses that don't make a lot of money, and you're actually better off just having a job. Yeah,
I think as well with that, a lot of people, particularly starting your business, you don't really think about business as an investment in itself. It will cost you money. Like you will need to invest your savings, and in the same way that you could choose to put your savings into real estate or shares or Bitcoin or anything else, it will require capital from you. And so you need to think about it as an investment. Yes, it's mostly you're thinking about it, I want to do something that I care about or I see an opportunity. And that's more of a job, like what work can I do that I care about if you're starting your business. But it is an investment as well. So thinking about that in terms of the risk and return there.
Yes.
Yep.
So I'm mindful that we're 37 minutes in. So we'll post this in the chat. So business, it's high risk, medium return. Yeah, you can make $1 billion, but you could
make a lot of money, but you could also
not
lose everything,
make any
right?
Money. Yeah. And it's in fact you could lose more than everything, right? It's pretty risky.
Yeah.
The barrier to entry is getting easier, which actually makes it more risky. Liquidity is extremely low. Selling a business is very hard, and it's not necessarily a great inflation hedge because as the currency gets debased, people's purchasing power gets eroded, which actually affects company profits. We've seen. If you look at earnings over time as a percentage, they've gone down over time. So companies make less profits today than they did 40 years ago.
Right. Yeah.
Right. So businesses, I think out of all of these ones we've selected here, the least appetizing. Public equities, shares. Now this is very interesting because public equities is such a broad basket, and so you could invest in the S&P 500, or you could invest in a single company, Tesla. And depending on how you approach it, it does change significantly its risk profile. So I think that when we look at this, we think risk, I think it really does depend, and depends on how you perceive risk. So if you look at something like the S&P 500, yeah, you're not going to beat debasement, but it's better than keeping it in cash, right? So are you going to lose money after taxes? Yes. Is it broadly going to stop you losing your money versus keeping it in cash? Yes. Is it fairly low risk in that it's got a very strong track record of going up and to the right over a significant time period? Yes, sure. The QQQ, though, which basically tracks the NASDAQ 100, which everyone thinks is just technology, but it's not. Pepsi's in the NASDAQ 100, right? So there's a bunch of consumables and stuff in there as well. That has tracked at 20% growth rate over the last 10 years, right? So that's actually a far better option. It's more volatile. Doesn't mean it's more risky. Just means it's more volatile, right? So you've got these different ways of kind of thinking about it. And, then there's like small caps, mid caps, large caps, indexes, single companies. So it really kind of depends on your approach in this. My personal opinion is to invest in disruptive technologies. I want to invest in stuff that has a deflationary force on the economy. So, but that's because I personally have the ability to and the interest in analyzing specific companies. And if you don't have that ability, then you can really stuff it up. So there was a situation recently where Google announced their quantum computing chip at Willow, and everyone was like, oh my God, quantum computing's here. We're all going to... And so everyone started trying to invest in quantum computing companies. The reality is that technology is a decade away from becoming a computer. Yeah. And I think in the last couple of days, some of the biggest names that people were investing in dropped 32% in a day.
Wow.
Yeah, because everyone turned around and went, oh, you know what? Like Jensen Huang from NVIDIA and Mark Zuckerberg said, guys, like this is like a decade. Away. This is like a decade away. 32%, bang. And you had all these people that didn't have a strong thesis, probably invested with the wrong time horizon. Yep. Bang, 32% drop. Yep. Now, 32% is not 100%. So when you think about risk, it's like, what is the risk, right? So if I'm aware that the stock market can drop 10%, I have 10% value at risk. I'm like, all right, cool. Am I good with that? Well, yeah, I mean, if I keep it in cash, it's going to lose 10% anyway. So what do I care if the market's got a volatility rate of 10%? So I don't really mind too much. But I think that there is an opportunity for good returns in equities, but it's not as good as real estate. Now, the reason it's not as good as real estate is because, personally, my opinion only, if you use leverage on equities, you're a fool.
I don't know if anyone could see our note here. Yeah.
Moderate leverage. You can get it. It's easy to get margin accounts, but it's risky as shit.
Official phrase.
Leverage increases the risk of significant loss, particularly in equities. Yes. Particularly in equities. Yep. Yeah. So with equities, you kind of want to own direct equity because then your risk of loss is only maximum 100%. Right? Yep. So the risk is that it goes to zero and you lose all your money. Yep. Now, you're probably not going to have that same risk in real estate. You can have a risk where it goes, you could buy a property and put in a 10% deposit and it could lose more than 10% of its value over some period of time and you could technically be underwater, but
that's likely to bounce back up, right?
It's likely to bounce back up because it has a core utility value.
Yeah, companies can very easily go to zero and then the company dies.
And they get bankrupt and they close down.
Yeah.
Yeah. So you can go literally go to zero and it's done. Yep. Done and dusted. Yep. But as long as you've still got the house, then you still have the asset. Yep. So, it can kind of come good. So there's less risk associated with that. Yep. So public equities, moderate volatility, you can get dividends for cash flow. And I'm a big believer, there's no point in buying real estate with 100% cash unless, there are some very small edge cases where that makes sense. We've helped some people do that in a very sensible way. But if your goal is income, there are other ways to derive income that could be better, right? If you're just using cash and you're not going to use leverage. Yep. Low barrier to entry, which is good because here's the thing. If you're trying to beat the debasement rate, let's say you don't have enough money to go and buy property because it's got a high barrier to entry, then how are you going to beat the debasement rate? You're not going to save your way to get in the deposit you need. So you've got to then think about how am I going to allocate capital in such a way that I'm going to beat the debasement rate and try and catch up to real estate. Real estate pretty much is like the best thing you can invest in. It's also very freaking hard to get into. Mm-hmm. So then it's like, okay, so how do you get your money to make money? One of my favorite things to do is make my money make money. I love it. I just love thinking about how does my money make money? The concept of it is just so interesting to me. How does my money make money? Because it's the best way to get ahead. Now, you could think about, okay, so let's say you've only got a small amount of capital, and we haven't even gotten to the capital allocation stuff, but you're trying to save up. What are your options? Save cash, stick it in the bank. It's going to debase at 10%. Properties are going to go up faster than you can save. That sucks. It's going to get 12% harder a year. That's tough. Or you could take some of your capital and you could put it in, for example, in the QQQ. That's had an average return of 20% a year for the last 10 years. Okay, so now your money's going to potentially go up by 20% a year. Doesn't mean it's not going to have down years and stuff like that. There's going to be volatility. But how do you get your money to work for you? So this can be a really good way because there's a low barrier to entry. You can invest with very small amounts of capital. You can get your money working for you. It can move you further forward faster. And it can actually serve as a savings mechanism to help you accelerate to get into real estate. It's very, very important to do. I don't think there is a better asset class than real estate. I would put Bitcoin and real estate as the two like apex in asset classes. Very different though, very different, completely different use cases, right? So the goal should be, how do you get into real estate? And if you're behind, then the question is like, how do you get your money to make money in the best way possible so that you can get into real estate? So there are great opportunities to do that with public equities, but you just got to think carefully about how you do that. So do you have any questions or thoughts around that before we move on?
No, not specifically.
Okay. Let me know in the chat if that makes sense to you guys, and what do you guys think about equities? Do you invest in equities? Let us know.
I think to your point as well, just earlier about there's a huge variety within equities and shares in itself, and so different people are going to benefit from investing in ETFs or funds, and just letting kind of someone else, a professional in that sense, pick what goes into that fund and trust their expertise to choose, and then you kind of benefit from that. Or you can go down the path of doing more research in individual companies.
Yeah. My personal opinion is most actively managed funds suck.
I was wondering what that face is about.
Yeah. No, so there's funds like and ETFs and stuff, but like most actively managed funds suck. You're better off, like in my opinion, either invest in an index like the QQQ, which is the NASDAQ 100, or the SPY if you want to just play that game, which is the S&P 500, or do research and find individual companies yourself, because you'll probably do a better job and you'll have better conviction. Because it's one of those things where, like, I don't know that you're going to be net better off in an actively managed fund versus doing it yourself, or just sticking it in the QQQ. Like, I was talking to someone the other day, and they wanted to buy real estate. I don't have like nowhere near enough money to buy real estate. Like I don't know, like they're not even close, right? They had thousands of dollars, right? And they're like, I want to buy real estate. I'm like, you're not even, literally you have thousands of dollars, not tens of thousands. But they didn't know anything about investing, and then they were like, okay, what should I invest in? So I started talking about that, and they're like, oh, should I invest in stocks? I was like, yeah, okay, cool. Like, let's talk about that. But they don't know anything. They're just completely green. And they're like, should I invest in Tesla? And I was like, well, I mean, I'm heavily invested in Tesla, but that doesn't mean you should be, because unless you can develop a thesis that you understand it, then you won't understand why it goes up and why it goes down, and how that may or may not affect you. So your better bet is actually just to try and pick an index that makes sense. And, you know, probably the QQQ is the better one to do. So I think, like, yeah, I would probably not personally go towards actively managed funds, because, you know, you look at something like ARK, Cathie Wood, huge amount of respect for the research they do over at ARK. They actually have dumb policies which blunt their returns. So they have these policies where they have to like sell off certain amounts of assets at certain times. It's like, why? Like, they take their best assets and they sell them if they take up too much of the portfolio. I was like, why? So as a result, their returns get blunted. So you need to be careful a little bit about that. Yeah,
and I think with like with ETFs and things, you know, I see a lot of particularly women online that in this investing education space, it's like it is an amazing starting point if you are very new to investing and you are not quite at the point where you can afford real estate and you haven't even started like conceptualizing Bitcoin or crypto or anything else. It is, again, we're talking about savings is not the way to go anymore. It's not really possible to just work. And I hate the idea of seeing people just work harder and just try and like work and just do more hours, take more shifts, take on another job, like build up more of their savings. I think like the work ethic from that is amazing. And I think we have loads of stories of our clients who have done that over the years, but I think times are different now in terms of just working harder to build more savings. Just to have it in savings is not enough. And so thinking through, if you are not ready to do crypto or Bitcoin or anything, and if you're not, if housing is not affordable, then thinking through ETFs is a potential good starting point to have it doing something. Yeah,
totally.
All right.
Yes, basically savings makes you poor, right? So savings makes you poor. So then the question is like, what are you going to do instead? Really, that's the question. So some good questions coming through here in the chat as well.
Yeah.
So public equities, if you do it correctly and smartly, can be a great way for you to not have your cash in, have your money, have your economic energy stored in fiat, right?
Yep.
And have it working for you. Bitcoin is another great alternative. Now, here's the thing about Bitcoin. Lots of people are talking about Bitcoin right now. Everyone's talking about Bitcoin. It passed $100,000 US. Oh my God, it's blah, 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 blah. It's great, right? The thing is, it is in the fourth year of its cycle, right? So we're now in the kind of fourth quarter of its cycle. Now, is its cycle going to continue? Like, is it going to have a perpetual bid? So because of the ETFs and because of sovereign wealth funds and corporate treasuries and stuff, is there a chance that it's just going to keep going up and this time it's going to be different and it's not going to have a bear market? There's a chance. There's like I don't know, maybe like a 30% chance that it doesn't have a bear market, that it just goes up and keeps going up for like the next, I don't know, 5, 6, 7 years. We don't know that though. So we have to reasonably assume that it's going to behave similarly to how it behaved in the past and for similar reasons. And, there's a whole bunch of like reflexivity and all of that kind of stuff that plays into it. So if you think about that in Bitcoin, if you'd asked me a year ago, my response would be different to now. Now I would say tread carefully. It's roughly $100,000 US at the moment. I measure Bitcoin in US dollars. So I measure different things in different currencies, right? But I measure Bitcoin in US dollars. So it's roughly $100,000 US right now. There's actually, I actually have some probabilities here that I calculated, that I looked up on the internet. And
I use my big brain for.
So there's a 49% probability based on Polymarket, which is, look, there's not a huge volume on this, but I looked up a Polymarket. It's a betting site, right? So there's a 49% probability that it gets to 150,000, 26% probability that it gets to 200,000. Okay, so we say roughly it's got a 50% chance of growing by 50% from where it is today, and it's got roughly a 25% chance of doubling from where it is today. Okay, doubling's good, right? 50% growth is good. What's your hurdle rate? My personal hurdle rate for our stuff is 20%. If I can beat 20%, I'm happy. Now, do I want, we actually sold a couple of things last night. One of the things we sold last night had a 397% return on it, right? And that's a whole nother, that's Leap, that's actually was Leap Options, which is a whole nother thing we should talk about in another scenario.
Another rabbit hole.
Yeah, that's a whole nother rabbit hole. But I sold a bunch of Leap contracts last night, and the lowest return one that I sold was 250% return, and that's in 6 months, right? So we can get really, really good returns. But if you look at Bitcoin right now versus where it was, say, a couple of years ago when it was at 15,000, right? Now it's at 100,000 and it might go to 150. The return profile is significantly different. If I look at real estate, and I know we're jumping around a little bit here, but if I look at real estate and I go, okay, what is the probability scenario for real estate over the coming years? Well, if we look at the RBA rate tracker, the ASX interest rate futures, there's a 73% chance, 73% probability of an interest rate cut in February, right? And that looks to be the start of an easing cycle of interest rates in Australia. Time will tell. We've been here before, all that kind of stuff, so we don't know. But what's the likelihood that if interest rates go down, liquidity increases, we're at the start of an easing cycle on monetary policy, there's more liquidity pumping into the system globally over 2025, and we know that Australia is a net importer of capital, what is the likelihood that real estate is going to perform very, very well in 2025, 2026? It's actually quite very, very probable. So then, so how much do I want to think about? How do I think about allocating to that? So I think about when and where we are in the cycle as we think through some of these things. So this kind of goes to some of the questions around Bitcoin and can you get great returns? Yes, but what if it's going to go down next year? Like what if next year is a bear market year and it goes down? So you need to plan accordingly and allocate accordingly. So anyway, Bitcoin, high volatility. Personally, I think it's very low risk. I think the risk of failure is almost zero, right? But it doesn't mean it's not volatile. High growth, low yield, very low barrier to entry, which is great, which means it's very accessible. There's high leverage, but the high leverage is incredibly risky, so you wouldn't want to do it. And it's got high liquidity, which is great, but that also is why it's got high volatility. And it's a great inflation hedge / store of value. So that's good.
Yep.
Cool. And we'll just finish quickly on the other one so then we can move into the capital allocation stuff and start getting through some of these questions because I think there's some great stuff in there.
Yes.
Other cryptos and altcoins.
Yes.
Are we sharing the...
Oh.
We're not sharing. So we'll share. There we go. Other cryptos and altcoins. So you'll notice that we differentiate Bitcoin from the other cryptos. Why? Bitcoin is more like a commodity. There is no CEO of Bitcoin. There is no Bitcoin Foundation that kind of controls Bitcoin. There is an Ethereum Foundation. There is a Solana Foundation. They're effectively companies, right? They are effectively technology businesses. Bitcoin is more like a commodity. And that actually is interesting because the higher the value go, the higher the price goes, the more the value goes up, the less risky it is. As opposed to companies where the higher the price goes, the more risk there is because it's more risk that the price is overinflated and it's going to come down. So the other crypto alternatives are typically higher risk with higher volatility, more likelihood of inflation, and inflation being token unlocks and all of that kind of stuff. So they're less good as an inflation hedge. The leverage on them is riskier even than Bitcoin. Low barrier to entry, right? So it's kind of like if you look at this matrix, there's only two assets or asset types on here that have got 4 green squares. That's real estate and Bitcoin, realistically.
Yep.
The other two, the next best two are public equities and altcoins. But again, you've got to be careful in there.
Yeah, you really have to know what you're doing.
Yeah, and so for example, I would never use leverage at all on any crypto stuff. We were talking about it last night, and it's kind of crazy easy to get. I was on an exchange, and it was like, oh, would you like 15x leverage or 20x or whatever? So you just hit a slider, and off you go. It's crazy. Yeah,
and this is kind of like it is an element of the leverage line in this table. It's like the accessibility of leverage, and there's two parts. There's the accessibility, but then also like, is that a good thing to do? Because a lot of these you can get leverage. You can go to an exchange or a bank or something and get loans to buy more of that thing. A lot of them you also can't. But is it a good thing to do?
Yeah. Probably not.
Maybe not. Yeah.
Yeah, probably not.
Yep.
So we're going to have a look at the capital allocation stuff in a second. But one of the comments we got here from Olivia said, what about effort / distraction of your time playing capital versus the reward of timing it to reallocate, i.e. put 50K in for now in Bitcoin, but then pull it out for property. So I think it's a great way to think about this, Olivia. I think it's a great way to think about it. The thing is you need to think about timing. So if the goal is to buy more property, then you should be thinking about how do you accelerate your capital in such a way that allows you to do that faster and better. And your options are, so let's say you may even already have some property, so that's already growing, that's growing your capital. But what about your non-invested capital? What do you do with that? Can you use Bitcoin as a way to accelerate your capital? Yeah, absolutely can. You absolutely can. So I do think about this as a savings acceleration technology is the best way to think about it. And I think that there's a part of the question in there around effort and distraction of your time playing capital versus the reward of timing it and reallocating it. Yeah. I don't think you should be a trader. Like I don't think you should be doing day trading or even swing trading. But that doesn't mean that you don't think about selling stuff, right? So you do have to think about your time horizons. And is it reasonable for you to speculate on something with a relatively small portion of your portfolio that you want to invest, and you have a strong belief that it's going to go up in value over a 12-month period, and you're going to use that as an acceleration pathway? I think it's reasonable to do. I think it's reasonable to do, particularly when you know that you've got 100% risk in keeping it in cash. I think it's reasonable to do. But you need to be careful of it. And I definitely do not advocate day trading. The success rate in day trading and short-term trading is like, it's minuscule. It's like less than 20%. So most people lose a lot of money doing that kind of stuff. But that being said, from how much bandwidth should you use to think about this kind of stuff, I can't think of anything more important. Like, I can't think of anything more important than, aside from like family and, like all this kind of stuff.
Thinking about the love of your life.
Yes, of course, right? So I can't, but like in a practical sense, there are a few things that are going to be more important than working out how to preserve or accelerate your economic energy so that you can live your best life. So if your options are just to be complacent and just go, you know what, fuck it, I'm just going to do nothing because I don't want to burn any calories on it because I prefer to watch Netflix at night,
Yep.
rather than thinking intelligently about how do I maximize my return on capital over any given period.
Yep.
I think that you could truncate your ability to get to achieve financial freedom by a significant number of years.
Yep. Awesome.
Awesome. Some great
Thanks,
comments in
Liv.
there. So let's go to the capital allocation scenarios, because this is actually going to lend into some of this, what we were talking about, actually.
Yeah, sweet. Ready?
Yeah, let's go into it. So now what I will preface is none of this is gospel, and this is designed to provoke conversation, and also to share my opinion.
Not financial advice.
Not financial advice.
Not financial advice.
And this is just my opinion, right?
Yes.
So if I was me, not you, me, if I was
If
me.
you were you.
If I was me and I only had $50,000
Yep.
in 2025 and I was trying to think about what to do with it, what would I do with it? How would I think about doing that?
Yep.
Well, $50,000 is not enough for you to get started investing in property. So property's out, right?
Yep.
You'll note that there's only three categories here: real estate, Bitcoin, and technology/equity, right?
Mm-hmm.
Now, I'll talk about that a little bit too, because for me personally, I wouldn't invest in the QQQ because I would invest in specific companies. I would invest broadly in real estate, Bitcoin, or Tesla, pretty much, right? Pretty much. A couple of other companies in there as well. But if you're not...
From the perspective of disruptive technology, right?
Yeah, from the perspective of disruptive, deflationary technology. There's also some other companies as well that we are invested in as well. So,
Yep.
But if you've got $50,000, you can't really invest in real estate. So then, what are your options? I would allocate 50% of my capital to Bitcoin, and I would allocate 50% of my capital to equities.
Mm-hmm.
Now, the reason I would do that is because doing so is going to be better than keeping your money in cash, because you're going to have a higher probability of increasing your capital. And that's going to move you closer to being able to invest in real estate. And I think that the diversification of the two ideas is going to be very useful.
Mm-hmm.
I don't necessarily think you should be 100% in Bitcoin. I think that there are other opportunities when I think about, and again, this is very specific to me personally. I like to think about things on a medium-term time horizon.
Yep.
But even if all you did was invest half your money in the QQQ, that's not going to get you as good a return, I don't think, in my opinion, based on what I believe, as Bitcoin over 2025. But it would give you some kind of downside protection, right? It would give you some degree of diversification or some degree of risk management in that. So that's how I think about that.
I think as well, something we've developed is an understanding of, if you really deeply understand an asset and you're really confident in your decisions, you don't necessarily need to diversify. Whereas I think if you are less confident and less educated about what you are doing, diversification can be a good strategy.
Yeah, but that's how I think about the QQQ, right? So if you don't know what you're doing,
Yeah.
and you're like, all right, I want to invest in equities or whatever, but I don't know what I'm doing, pick an index,
Yeah.
right? Because that's going to give you the diversification.
Yep.
Don't pick 20 things.
Yep.
Right. So, I mean, I can list on one hand, aside from, if we take out real estate and business, if we just look at current assets, right? So like liquid assets, I can list on one hand the amount of things the amount of different companies and cryptos and stuff we're invested in. Right. So there's a degree of diversification, but you don't want to go wild with it.
Yep.
So I think that's important.
Cool.
Now, the goal here, of course, would be acceleration of capital so that you can get into real estate. All right. So let's go to the next one. So we're going to go up in $50,000 increments. So if I had $100,000 right now to invest in 2025, I would put 100% of that into residential real estate in Australia. Now,
Why?
that is going to get you a property that is going to be, I didn't do the maths on that, $300,000-$400,000. Don't quote me on that. I'd have to double check my workings on that. But that's going to get you in the market. Now, I actually think that from a risk-adjusted return basis, that's the best thing you can do with your capital. But the problem is it's got a very high barrier to entry. So if I had $50,000, I'd be splitting that half and a half between disruptive technology and Bitcoin, or equities and Bitcoin. If I had $100,000, I'd be 100% in real estate. because the goal, if I've got $50,000, is accelerate my capital to the point that I can get into real estate.
Yep. And obviously use leverage.
And obviously use leverage.
Yep.
I'd be using 90% LVR with LMI capitalized in the loan, which kind of nets out to be about 88% LVR.
Yeah. So
me personally.
Yeah, if you had 20% deposit and costs, it would be a $500,000 asset.
Yeah. I think it'd be something close to like 400 to 500,000, depending on the location.
Yep.
So because that's going to help me accelerate my capital much faster, in my opinion, and on a risk-adjusted basis. I think that's going to be a better move.
Yep. I will actually say, $500,000 properties. If you pay attention to the news, you may be like, "Where the hell do you get those? Those don't exist anymore." They do. Our average in 2024, I think, was $485 when I calculated it last, the average purchase price. And that was through all of 2024. But my point being, that's the average. Like that was the median, being that half of them were less than that. And so it's definitely still possible. You need to obviously know where you're investing, picking the right locations that you can get in at that price, and also have good prospects as locations themselves. But $500,000 is definitely still possible for real estate.
Yeah, 100%. I would also just put another point on that, that over $500,000, like 500 to 650 is actually a real sweet spot for getting the best opportunities, right? So $100,000, so if you've got $70,000, you could get started investing in property today. And so by the way, if you want help doing that, we'll put a link in the show notes.
We know a guy.
We know some guys. We can help you do that, and we're very good at it. But look, start working with Dashlot, you need about 70 grand to get started, roughly.
Yep.
So if you're in that kind of range, great, we can help. But that's how I would think about doing that. If I had $100,000, bang, I'd just put 100% of it into real estate. I would work with a company like Dashlot to get the best possible returns. That's what I would do. That would personally be what I'd do. Yep. Let's go to the next one.
Great.
Blake, I'm going to come back to your question at the end there. I think it's a really interesting question you posed as well. I'm going to come back to that a little bit later. Cool. So scenario 3, I've got $150,000.
Wow.
I've got $150,000. So what would I do with that? 100% in real estate. Now, again, the reason being is that's just going to help me to get better real estate, right? So that'll actually help me to buy something like a $600,000 property, roughly, right?
What are you using? 88.
Yeah, I've got an Apex report in front of me.
Got it. Yep.
Yeah, so that's going to help you buy a property that's going to be somewhere between, sort of depending on where you buy and what the costs are on a state by state basis. That's going to help me buy roughly a $600,000 property. There may be some change. Maybe I buy a $500,000 property. There might be some change. And by the way, if I had change left over, I would do two things. So let's say I only spent 130 of that 150 to buy real estate, and let's say there's $20,000 left over. I would keep some of that for a slush fund for the property, so that I have enough capital to cover any kind of costs of maintenance or any kind of negative cash flow. If I had more than enough left over, then I would consider allocating in a 50-50 way to Bitcoin and technology. That's why I do it. But broadly, I would take 100% of my 150 grand and I'd stick it in real estate. Why? Because I can buy one house that's going to be, we'll call it in the sort of 500s and 600s range, right? Depending on where you buy.
Yep.
So that's going to be the smarter move.
Yep.
And I wouldn't bother with Bitcoin. I wouldn't bother with tech equity because the risk-adjusted return base is going to be better. Now let's go to scenario 4. Great. We just got Olivia just got an amazing property for $560K. Nice. That's awesome. Okay. So now in scenario 4, I've got $200,000. So what would I do with $200,000? 100% in real estate? No. Why? Because the difference, like, we're going to start pushing up into a price bracket, which is, I don't think, going to be necessarily more beneficial. And at this point, I might want to think about some degree of diversification. So I'd still take 150 grand. I'd allocate it towards one property, and I'd take some of that. And if I had, of that 150, if I spent 130, I'd keep 20 grand aside. I'd keep that as a slush fund for the property. And then then I'd take the other 50 and I'd split it 50-50 between Bitcoin and technology and equity. Technology equities. Make sense?
Yeah. Is there a specific reason why you've done evenly between Bitcoin and tech and equities?
Yeah. So there is actually, because I believe that over a 5-year period, Bitcoin is a better opportunity than technology and equities generally. But I think over the next 12 months, I think that there's probably an even chance that disruptive technology could outpace Bitcoin. Now, that's because if you think that there's like a 50% chance that Bitcoin will go to 150,000 US, that's a 50% gain. Do I think that I could invest in technology companies that would get me more than 50% return this year? Yeah, I do. Is there a chance that Bitcoin goes to 500 grand this year? Yeah, there's a chance. I mean, I don't know, like 1 or 2% probability maybe, right? But so I sort of on a probabilities basis, I think that there's a chance that technology could outperform, specific technologies could outperform. Now, and again, it's about kind of, it's hedging a little bit as well, I would say.
Yeah.
But I would say that over a 5-year period, I think Bitcoin's a stronger asset. And the reason being, you don't have a CEO, right? So like, Elon Musk could have a plane crash and, everything could go to shit in all of his companies, for example.
Yeah.
And you see all kinds of stuff happening all the time. You see like all you need is one big controversy and something a company can dip. And they can dip for no reason. Like something random can happen. In fact, I was reading an article today about a company that built they were a company that released reports on companies, right? So they started as like a research firm and they did this like investigative journalism type stuff to uncover overvalued companies. And that was kind of how they built their name. And at first they did some really great stuff. They uncovered these big frauds that were happening in companies, and the companies where they uncovered and just, the fraud, the companies would crash. This company that was releasing the reports was short selling. So they would uncover these big controversies, short the company, release the report, the company would crash. Now, the problem is they did that really, really well, very, very good a bunch of times. But then it was to the degree that all they needed to do was release a report and the company would go down.
Yeah.
So they actually did it recently. The last one they did, I think, was with Carvana, which is like a camper van company. And they shorted Carvana, released a report. The company went down by 11%. The CEO came out and said, "That's all bullshit." And then the company went back up 11%, right? So it's like, and now the research company has decided to disband mysteriously. Anyway, whatever.
Yeah.
So the point is, there's more risk. There's more risk in technology companies.
Well, it's all very sensitive, right? It's sensitive to consumer sentiment and what's going on with that company, or just consumer sentiment, how people are feeling. Before we move on to the next scenario, I'll just pull up Liv's question.
Yeah.
On the 200K cash scenario, why not split that 200K into two $100,000?
It's a great question. There is more competition at the lower end of the market.
Yeah.
So there's way more competition at the lower end of the market right now, and that means that it's harder to buy, and it's harder to buy as well.
Yeah, and you are more likely to overpay for something,
and it's going to take you longer.
Yeah.
Right. And so then you've got a time consideration. You've got a time consideration around opportunity cost of how long is it going to take you. Can you buy a $250,000 property in Australia today? Yes, you can. Can you buy a good one? Yes, you can. Is it hard? Yes, it is. And so again, this is for me in my personal circumstances and how I would think about this. The way that I would think about this is that for 150 grand, I could get a better asset faster, and I could get my capital working for me quicker, and then I wouldn't have to think as much about it. Or I could try and buy 2 cheaper properties, and it's probably going to take me way longer, and I might not get as good a property. I might not be in as good a condition, or potentially I'll pay, I don't want to say pay over market value, but I might be kind of forced into a position where I'm in a high competition situation. And so I don't know that my returns are going to be as optimal. Are they still good? If you've got 100 grand, freaking go for it. Like, go for it, because it's still going to be better than not doing it. But if I had a choice, I'd be like, what's the fastest, easiest way? How do I minimize opportunity costs, time? And I'd just go, bang, let's go 150. So for me, that's like a nice, sweet entry point. That's how I think about it. Plus, also, Liv, I would want to get exposure to Bitcoin. Right? I actually think it's very important that everyone has exposure to Bitcoin. And so, but I don't think that you should do that if you've only got $100,000 or $150,000. I don't think that you should delay getting into property just so you can go buy some Bitcoin. I don't think that's a good idea. So it's like, at what point does it make sense? Either before you have enough capital to buy real estate, or once you have enough surplus capital that you can make some decisions about how you allocate that in a kind of more segmented kind of fashion.
Yep.
Okay, so let's keep going. So $250,000. So quite similarly, this is actually pretty similar to the last one. Buy one property using 150 grand. then allocate the rest of the capital 50-50 into Bitcoin and equity, pretty much, into technology. Same reasons, just a slightly higher number. Let's go to scenario 6, because this is the most interesting one.
$1 million.
So let's jump it up a little bit, right? And let's say that you suddenly got $1 million, $1 million cash to invest in 2025. Oh, sorry, let me pretend that I've got $1 million cash, not you, me, right?
We've got $1 million.
Yeah. So none of this advice is for you. It's all what I would do.
We are speaking to each other.
Yes, exactly, right? So this is what I would do. I would, in this case, I would go 45% of the capital allocated to real estate, because that would get me 3 properties with about $150,000 capital of each.
Yep.
Now, there are other ways you could carve this up. None of this is supposed to be exact, right? You could allocate $500,000 or $600,000 to real estate, or you could go you could do like whatever 4 times 125,000 is, or whatever. There's a bunch of different ways you could carve this up. I'm just saying, for me, here's how I would think about it. I can go buy 3 properties at a good price point. I can do it quickly and easily and get good properties that are going to be in and around that $600,000 price point. Bang, bang, bang. Let's go. Let's get 3. That's going to set you up for a huge amount of success. That's going to, because I then think about what's next. Those 3 properties are going to compound rapidly, right? That's going to give you plenty of capital to move into other assets pretty quickly. That will set you up to expand your property portfolio very quickly. So then you've got this. So your engine's really running on the real estate front then. So I'm like, good, we're good. We've got 3 properties a turn. I would then want to go and buy some Bitcoin. I would want to own more Bitcoin than equity, because I think it's less risky over the medium term. I would want to be thinking about capital preservation and not just kind of short-term capital appreciation. So I'd want to be thinking about, over the next 5 years, where do I think this is going to go? And I'd go, okay, well, I'd want to own more Bitcoin than I would equities. And then I'd want to allocate a small portion to equities as well.
Yeah, because looking at this split, I think you're thinking like real estate, like you said, we've got this foundation that's just humming and compounding, right? So that's kind of like the steady growth play. And then we have Bitcoin, which is the inflation hedge. It's the preserve our wealth over the long term.
Yep.
And then tech and equity is more
deflation.
Yeah, okay.
Yeah.
Yep.
So this is the way that I think about it, right? So deflation causes inflation. So the more productivity gains we get through technology, the more that it forces prices down. And those productivity gains, everyone thinks like, GDP is a function of productivity, debt, and population. The problem is we're moving into a stage where the productivity gains are not going to be based on labor, right? So we're not going to have more people doing more stuff. We're just going to have stuff that's being created in a more abstracted way with machine and technology, right? So we're going to have significant deflation. So this is going to create the biggest deflationary force that we've ever seen. The thing about that is the governments can't handle deflation, because then the debt costs more tomorrow than it does today. That means the underlying collateral base of the country, like real estate, would be at risk. All of that kind of stuff. So they're in a position where if there is deflation, the only thing they can do to kind of keep the system solvent is to print more money. Right, so the degree to which technology creates deflation, which it is doing at an accelerated rate, is the degree to which countries are going to need to print money.
So it's like they're racing each other.
Well, yeah, I mean, it's just like they have to, have to, or their whole thing breaks.
Yep.
Right, so deflation causes inflation, and so. The real estate, it's a call option on inflation, right? The real estate opportunity is you're basically saying, okay, the government's going to print more money, my real estate's going to go up. Awesome. Companies are going to continue to improve productivity and cause deflation. I want to own a piece of that. And then I want to take a slice out of the middle where I have something that has got, over a long time has no inflation, but a very low inflation rate is Bitcoin. It's not, people say Bitcoin's deflationary. It's not deflationary. All it is a stable form of economic and energy which allows deflation to appear in the market. Technology is deflationary. AI is deflationary. Bitcoin just allows the deflation to become visible because it doesn't debase. And that's the big difference. So my broad thesis is that you want to have a decent amount of your capital allocated into the system that doesn't work, i.e. the broken money system, which causes asset prices to go up. You want to play that game because they're going to play that and it's only going to get faster. So why don't you play that too? and then you want to have some of your capital that is isolated, inoculated from that, that parade of horribles, right? And that's Bitcoin. And then you want to have some bets that are going to go with the deflationary force that are going to create the deflation. So that's the kind of 3 ways to allocate that. Yes.
Sorry, just reading comments.
Yeah, I'm just reading comments too. I love the comments.
Awesome. Well, we can go through questions now, I think, because we have the 6 scenarios. Sweet. Okay. Where do we start?
Where do we start? So I want to start back up at Blake's question. He said, what would you do? You've got a large chunk of equity in your owner-occupier property, 90% owning a $700K, but you can't get an investment loan for property, right? So I'm assuming that means you've got a $700,000 property and you've got 10% owing on it, and you own 90% because you said you've got a large chunk of equity. Or I might have that the wrong way around. I might have that the other way around. Either way, if the situation is you can't get a loan for an investment property, that sounds like a serviceability issue to me. Mm-hmm. So if you don't have the serviceability to be able to get more property and you want to expand your property portfolio, then you would want to consider rent vesting. Now, I say that carefully and cautiously because if you've got an owner-occupier home, maybe it's your family home, and maybe that's an emotional thing that it's very important for you and your family to own the home, and maybe you're like, rent vesting, why the hell? But I think you should consider it because that's going to free up borrowing capacity if the goal is to accelerate your capital. If it is more important for you to have a family nest than it is to accelerate your capital, then the only other option would be to work out how to make more money, basically, how to increase your...
Ooh,
oh my God, I've disappeared.
We lost Goose from the screen.
Let's go. I'll come back.
Okay, you're back.
So yeah, the only other option is to think about how to increase your income, Blake. That's the only really thing you can do. And then if you're going to increase your income, you're going to increase your capital. So I'm not 100% clear whether it means you've got 90% owing or you own 90% in that. But either way, if you're borrowing capacity constrained, there's only a couple of options. Either increase your income somehow, or you're going to have to decrease your debt relative to that, or your non-tax deductible debt, which would be potentially look at selling down the asset, or potentially look at renting it out and rent vesting. That might free up some capital. But of course, you need to go speak to an accountant, speak to a mortgage broker about that because it could be options. By the way, we have a really great property investment mortgage broker. So we own a company called Dash.Finance. If you want to get a second opinion on that, where can they go? How do they get to Dash.Finance?
It's TBC.
Do we have an email address?
I don't know.
Yeah.
Yet.
What about Callum? Can you just get Callum's email address and we'll stick it in there for Blake?
Yeah, I believe it would be Callum, so C-A-L-L.
Yeah, let's type it in and then otherwise I won't get it.
I'm just going to say the words because people know how to spell. Callum at dash.finance.com.au.
I'll type it in.
Goose is typing. I'm going to multitask at the same time. Let me just go back through the comments. Yeah, we will have a link in future. We'll have a link in the show notes. But Callum's really amazing at thinking through all these different scenarios, and even if you just want advice of, hey, this is my situation. What does that mean finance-wise and mortgage-wise? What can I get? What's possible? I'm thinking about doing this. Does that make sense? Should I think about it differently? He's really great strategically as well. So shoot him an email in future. We'll have some
I've
kind
just
of
put
link.
it in the chat, so we can do that. Yeah. So Blake, I've just seen your second comment there. You're 90% owned, so you own 90% of the property, which says to me that there's something wrong. There's something wrong with it. By the way, congratulations. That's awesome. That's great. You're in a really great position. You should be really proud of that. You should be very happy with that position you've got yourself into and got your family into. So well done. If you're stuck on borrowing, get in touch with Callum. Have a chat. Reach out. Tell him you've been on the live with both of us. Have a chat with him, see if he can help you to unlock your borrowing capacity. But they're the solutions that I've got for you today. I hope that helps.
Awesome. I'm going to go back up. I remember Peter Boone had a question. This one.
What would be the best asset class to invest in 2025 for the next 5 years to grow your capital as fast as possible and not impact your cash flow? That is such a good question, because if you had just said grow your capital as fast as possible, I would have said real estate. Because it's very hard to find another way to grow your capital faster than you can in real estate when you consider the ability to use leverage. So you can buy an asset, it goes up, you take equity out, you go buy an asset, you buy another asset with basically, it's an infinite money glitch. Your ability to accelerate your capital, assuming you can afford the cash flow, is freaking wild, right? So if the comment was, what is the best asset class to invest in 2025 for the next 5 years to grow your capital as fast as possible, I would have said real estate. But with no impact on your cash flow, I would say Bitcoin. Now, I say that carefully and cautiously, right? Because I will continue to say that real estate investing in Australia is the best risk-adjusted return that you're going to get. It has downsides with it. It's capital intensive.
Yeah.
Right? It's got low liquidity, all this other kind of stuff. Now, I'm not here to shill Bitcoin, but I've done enough research on it to have developed a fundamental belief that I believe it's going to be worth $1 million by 2030. Could even, maybe even sooner. And so I think about that from now, and then I say, okay, well, if it's 100,000 now, and then it'd be $1 million in 5 years, that's a 10x on capital in 5 years' time. I'm like, that's pretty good. That's pretty bloody good. And very few things are going to give you a 10x return on capital in 5 years' time. Real estate will. Australian real estate will if you play the game right. You'll get a 10x return on your capital in 5 years. Again, I said it earlier, we got 15x in 5 years, right? So you can definitely do it in real estate, but it does have some significant barriers to entry. So the next best would be Bitcoin. And the reason I'd say Bitcoin is because I think it's got the next best risk-adjusted return because it's a commodity. Now, if I wanted to go slightly further out on the risk curve, I would probably say Tesla. Now, I'm not an Elon Musk fanboy, so don't. When I talk about Tesla, don't mistake me. I'm not sort of just sitting here kind of fanboying about Elon Musk. I'm not. I look at what the company is. I look at all of the revenue streams. I look at all the opportunities. I think that there's a decent chance that 10x's or 5x's probably right over the next 5 years. So that's probably kind of like the next big bet. I would say. But yeah, I would consider Bitcoin as the next kind of option after real estate.
I think if we go back to what we were going through in the asset table, we were saying that some assets obviously have different benefits. The same characteristic can be a benefit, but then it also means it's a negative characteristic at the same time. So the fact that you can get leverage on real estate means that it's harder to get good cash flow from that asset, right? Because you have interest and you're making repayments, and that's negatively impacting your cash flow. Versus Bitcoin, probably not a great idea to go and get leverage on that, which means that on a day-to-day basis, there's less impact. Like there's no impact on your day-to-day cash flow. So it's a benefit there. It's like it's negative because you can't get leverage, so you can't do that.
You can get leverage.
You can,
just be
but
stupid
we're saying
to do it.
it's not a great idea to do that. But then the downside being that, the upside being that there's no impact to your cash flow. So it's like two characteristics, meaning same but opposite things, if that makes sense.
Yep.
There was another question.
Josh McMillan is any tools or guidance on how to track overall growth across assets? In the future, we are going to do a session on how to build a personal balance sheet. And that personal balance sheet will also have a way to calculate your returns on your assets as well. But that's going to be a little way away.
Cool. Another one from Booney. With Bitcoin, are you comfortable holding it through an exchange like Binance, CoinSpot, or do you hold it in a hard wallet?
It's never a good idea to keep your Bitcoin on an exchange.
No. So I think... because I speak with people about kind of getting into Bitcoin quite a bit because obviously everything we're researching and what we've been speaking about, and I think exchanges are a really great way to start. They're the most user friendly. They're going to get you in. They're going to like guide you through how to buy it. It's relatively straightforward. It's not the best idea to hold them in there if you are going for a decentralized approach to managing your own wealth. There's a process where you basically take the Bitcoin off of the exchange and you put it in what's called a cold wallet.
Yeah.
And that means it's actually quite interesting when you do that because
so stressful.
It becomes very stressful because it makes you realize that this service that you've been paying for being a bank and you keeping what you think is your cash in this bank, and you actually pay for the service. And part of that service is this sense of like, okay, somebody else is responsible for that. And I don't have to constantly think about where is my wealth. And when you start exploring Bitcoin and you start to pull your own assets into your own cold wallet, it sits literally in like a hard drive type device in the physical space. So it's not a digital thing anymore. It becomes like a physical asset, and it's not connected to the internet at all, which means that it can't be accessed by anyone. But you are ultimately responsible for that.
Yeah.
And it's quite a weird feeling, because it's, if you lose access, if you lose your keys, if you forget things, it's gone. Like, it is gone. Nobody else can access it. So it's very secure, but it's also a lot of responsibility. So generally speaking, if you're going for security, it makes more sense to keep it off the exchanges, but it is a good place to start by having them going through an exchange like Binance or CoinSpot or Kraken or something. So I hope that makes sense.
So I've got a meeting that's supposed to be starting now, but I've managed to push it back a little bit. But we'll just do a couple more questions as well. So just quickly, so I want to answer Jani's question. What would happen with property prices? But just quickly, Olivia, I never considered tech to be deflationary. The natural state of the free market is deflation, right? So yep. all progress comes through the development of technology. All progress comes through the development of technology. And the natural state of a free market is deflation, which means that the progress of technology specifically is deflationary. And the only reason we don't see deflation is because of monetary inflation. It's one of the biggest lie that we've ever been fed is that for economies to work, there must be inflation. The natural state of the free market is deflation. That is the natural state. And the problem is we've never actually existed in that state. We've always existed in a broken system. So how do you see a system from within? How do you observe the universe from inside the universe? Right? How do you see a system from in? How do you see outside the system from within the system? It's hard to do. And so the paradigm has to shift significantly. And we're gonna get that. All right, we'll do one more question, I think. So Jani's question, she had a great question in here about...
Ooh, nice. What would happen if we end up with property prices dropping like in China with oversupply? Would that happen to Australia?
I mean, there's would it and could it and all of that kind of stuff. Could it? I mean, it could, in theory, if there was a massive oversupply, but the thing is there's not.
Yeah, we're a long way, I think,
there's
from
massive undersupply in Australia. So one of two things would have to happen. Either we'd need to, 10x the rate of building approvals for like the next 10 years. Like, it would have to be the most insane increase in building ever, which is improbable. Or everyone would have to move out of Australia, which is, again, improbable. Because the reason we have such a shortage is we have an imbalance with the amount of people we've got and the amount of houses we've got. And it's a very significant imbalance. China was different, right? So what China did is China stimulated their economy. They wanted to grow their economy, and so they stimulated the hell out of their economy. And they basically said, go and build stuff. They went and built entire cities that had no people living in them.
Yeah.
There's even stories where they built cities, knocked the cities down, and then built them again. And the reason they did that is because they wanted to keep money pumping into the economy. They wanted to create more jobs. They wanted to do all this kind of stuff. So they basically artificially inflated their GDP. So our situation in Australia is very, very different to the Chinese situation. If you build properties that people don't need, then you're going to end up with an oversupply. And they stopped the kind of the monetary scenarios, which would continue to prop those up. And now they have a big real estate collapse. It's bad. The Chinese government wants to print more money. The problem is they can't. If they print too much money, I know they printed. I'm supposed to have a meeting with Sean right now. And he's
Sean.
just jumped into
Goose is running late.
Yeah, I'm running late, Sean. I'll be there in a sec. So the PBOC or the Chinese government, they actually want to print a lot more money, but they can't until the dollar comes down, because otherwise they'll break the peg to the dollar and their economy will collapse. So they printed 989 billion yuan yesterday. But that's a drop in the bucket of how much money they need to print. So the short answer is, Jani, I don't think it is. We're not going to face a very similar situation, because, as Sean has just put in here, no labour, no materials, no approvals. Even if you fix it, it'll take 5 to 10 years to see results. By which time we're predicted to have 15% population growth. Can Sean take some
Can I take
questions?
some
Sean, do you want to come on?
Welcome.
Do you want to come and do? Do you want to come on and do an
Let me jump
episode with
on.
us at some point? You don't have to jump on now. We're going to talk about some other
Sean
stuff.
says yes. Sean says, I would love to.
Sean can come on and do an
I
episode.
love being the
at some
center of
point as well.
attention.
Anyway,
Cool.
guys, it's been an amazing episode. Let us know if you've enjoyed this today. It's been 93 minutes long,
Beautiful.
so that's good. So we
Great.
probably need to adjust our calendars to account for 90
I know
minutes.
it's seeming like 90 minutes is about where we get
Seems
to.
like 90 minutes is about the time.
I think we need to make time to answer questions, and we want you guys to be able to show up here every week with whatever questions you have about the topic or anything else that's happened in the week. So maybe 90 minutes does make sense because we do also want to come to the table with some content and some questions that we want to talk about as well. So if you have any opinion on if 90 minutes is not cool, let us know as well, but I'll adjust some stuff so that it's 90 minutes. I think this is really helpful. I hope that you have now got a bit more of an understanding about how to compare asset classes as an investor. Again, you may already know this stuff. We tried to do high level, just comparing the top characteristics that we could think of. And then obviously I think going through those scenarios, I think was really helpful of how we would invest, not financial advice, but how we would invest at those different scenarios coming into this year. And hopefully now you're starting to think about, okay, I have this amount of capital. This is where I'm currently at in my situation. These are my goals. This is now I can start to think about these different asset classes, and hopefully you've gotten more insight out of this episode.
Indeed.
Great.
Okay, guys.
Thanks, guys. See you
See
next
you next
week.
week.
Bye.